From the rotunda of the Carnivore compound, deep in the heart of Las Vegas, comes one of Wall Street's Hall of Fame traders, Dutch Masters. Today, Dutch is joined by Carnivore's hand-picked customer protege, who went from being a K-9 cop on the streets of East Tennessee to full-time trader and market strategist, and now heads the Carnivore VIP program. The man who has a guy for anything and always has an answer for everything, even if you didn't ask. Please welcome Godfather.
I tell you what, I love it. Hello. Welcome, everybody. We are here. We are live. Tennessee, we are in Vegas. We're all over the place. What's going on? Got Scotty, got Sal loading in here. We've got Dutch on. Dutch is on early today. Glad y'all made it in. It is Fed Day. It is Powell Day. Dutch, I've been busy trading, doing all this stuff. What's going on? What's going on out there? I'm going to write to you on this.
Yeah, what a great day, man. I mean, a great couple of days here. Yesterday I was pretty ticked off about Bitcoin, what it was doing to us in the ETF. But then when we hit SMLR, Similar Scientific, that kind of recharged the batteries and made everybody rock and roll. Got all kinds of love out there. You guys were sending me emails and sending Godfather emails and in the chat rooms and rocking and rolling. Everybody was like, man, that was a hell of a ride, man. I don't know, 6 points, 7 points in a day. And then we're like left the whole position on because we kind of thought that maybe it might follow through today. We thought that this pullback in Bitcoin would be a short-term, one-day type of thing. Turned out we were right, and it has turned. But we do have some resistance up here, so you got to pay attention to the price action, right? So we started to sell off. We had about 20,500 or so of the IBIT. We're down to about 8,400. Just because we wanted to take that position down. It's still a large position. Yeah. But with the bounce today back up towards the resistance line and some of the profits we were able to take on SMLR here at 44 and change. Of course, it went up to like 45, 46, I think.
Yeah.
So, we didn't top ticket, but we sure got it good. We got a good, 8 points on the thing in general in one day. So one overnight trade there. And I think the thing can keep on going, but, I just didn't want to hang around for it in front of Powell. So we took some stuff down and we crossed $1 million in the model portfolio. So first time this year. Congratulations to the team, Trader Z, Don, Godfather, everybody. We kicked ass, and here we are, literally almost one half of the way through the year, and we're at 300% year to date, and we're up about 7-8% for this month. Mm-hmm. Hey, I sent you a grid of the monthly performance this month. Why don't you throw that up, can you?
Okay, yep.
I sent you that in an email. Yeah, we've had a lot of good consistency. Thank you, Scotty. Appreciate it, man. We try to get a 300% kind of return off of the model portfolio for the year. Here we are halfway through and we've got it. So last year, I think we went from 250,000 as a start in January 1, and we went to 1.6 million. So, if you really want to look at what, people could replicate, cut that 1.6 in half, right? Just cut it in half. So let's say there's trades that you missed. Let's say there's trades that you don't get executed on, that great, whatever. And you make some mistakes along the way. And, maybe we're getting into something that's harder to get into. But the reality is, look, man, we're looking at maybe 800,000 on a $250,000 start. So Greg Wander says he's hearing background music. I don't have any music playing. So Wander's kind of a crazy dude. So he might be hearing that in his head. I'm just kidding.
He doesn't
I'm
like
just
music, huh?
I'm just kidding. I love the guy.
Poor fella.
No, and he's got some interference in the background.
Well, no,
So
it's
anyway,
the background music we have going, yeah.
so anyway, so we're kind of sitting there. We laid on a couple of things here this morning. We went ahead and got the defense contractor LOAR, and we went ahead and we added to ADUS, which is performing well. It really looks like it wants to take off. And that's a sleeper, man. No one really even saw those guys coming. We didn't pound the table on it. We just put it in. And I think today was the first day that we added to it. And she really looks like she's starting to act right. So that's ADUS.
When you wanted to, Dutch, you see it there? Is that what you're looking for?
Let me just see. Let me pull the screen up here. Well, I don't see anything.
Year to date.
Oh, yeah. That's it. Yeah, that's it. That's the one.
Okay.
All right. So if we blow that up, you can see, okay, so we started 250 in January 1, and you can kind of see we had a great January, great February. March was a rough month. And then April, May was okay at 14%. And here we are halfway through the month here, or close to it, and we're up about 8. So we crossed that $1 million mark, and pretty excited about that. So,
yeah, no, that's great. I don't know. I'm trying to remember. This is probably the earliest. Is this the earliest we've ever hit $1 million?
Yep.
Yeah. This is the earliest. I think someone in the VIP group, for those that went to the academy, I think someone said, "Hey, do you think we can double that by the end of the year?" So
yeah, and I'll tell you what happens is when you get to this level,
yeah,
now you can swing the bat a little harder. And you can also swing the bat more often at more opportunities. And that's the whole thing is, Trader Z and I sit there and we talk about, we kind of early on, it's kind of tough to punch out numbers. You got to be really, really right a lot. You can't sort of take a probe into a position. You don't want to go into something that's too risky or whatever, because if it hurts you pretty bad. But when you got $1 million in capital now, instead of going after 5 or 4 or 7 positions max in a swing trade portfolio, you can go and do 10 or 12 or 15, even 20 if we get into a bull here, and you can start just popping stuff on. Personally, I have trouble handling as many as 20 positions, because if you guys have learned what our style and our technique is, if the stock is moving and I've got to add to it every 30 cents, 50 cents or $1 as it's moving, doing that with 20 positions is really, it's kind of, you're busy as hell, right? And you're going to miss some things. So I like to keep it tight, and the tighter the better. Really, maybe 5 to 12 positions. You'll have, if you have 12 positions, you're going to have 4 that might move in a day max that are moving enough for you to have to add to, and that's easy enough to keep track of. But that was a lot of fun yesterday when SMLR was just going up. Every time I would hit it, it was time to hit it again. It was just like hit it and hit it again, and then hit it again, and then hit it again. Now we hit that thing from 36 or so all the way up to 42, and then it paused and peeled back, and so when we were buying and scaling in, we were buying larger amounts of stock early, and then as we went up and up and up and up, we started to buy fewer and fewer shares, so that by the time it got to about 41 and 42, we were buying 200 shares instead of 500 shares,
right,
as we were adding. So when it did turn over and roll over, we had losses of about $700 or $800 on the last 4 buys or so. I put that in the wrap last night so people can look at it and see the actual results there, and how that kind of works and why it all makes sense,
Yeah, no, it was great. I think the messages that came out on that, they were pretty flawless. You were really clear and really precise on when it was going to get to that certain amount. I think even in our last text, didn't you say that we were going to wake up something? It was going to hit 43. I mean, I think 43 was the number that we had sent that you had sent out. And said, hey guys,
I think what I said is we're going to wake up in 36 hours and it's going to be at 44. And I said, just saying.
Yep. And then I think when I woke up, I think it was at 43 something. So no, that was pretty amazing, I think. But that was a real righteous trade. Now, of course, we've kind of gotten out of the way of Powell, right? That's typically what we do. I think maybe some of the people on here kind of figure how should people be positioned? We're about 19 minutes. So the way this works, if y'all don't know, is the Fed minutes come out. Some have already leaked. There's some stuff online, but the actual results, they come out at 2, and then the press conference starts at 2:30, which we will stream. How would you be positioned right now if you were maybe just watching us?
Yeah. So, I mean, really what I want to do is, I mean, my biggest position's IBIT. We're at 39.76. It's up 3.5% today.
Mm-hmm.
If this thing continues to run up to the discussion and he clears 40 or whatever, I might even take half of what I've got left. I got 8,400. I might take 4,000 off just because I know we're up against resistance on Bitcoin.
Right.
So that means I got to stick around and wait for it to do the work to punch through it, or take the risk that, or make the bet that Powell's going to say something like fantastic and that it's going to, go straight through 72,000 or something.
Yeah.
I think it'll go through 72,000, but I mean, we're up 3,100 on the thing already today, which kind of took care of all the losses we had on it yesterday. So now, okay. So SMLR is now dropping down below 40. That's very interesting. So that thing's turned, hasn't it?
Yeah, no, absolutely. That's what I was just looking at myself. But let's see how much. What we have, we still have some though.
Oh yeah, so we had 7,900. Now we have 900. So we're just kind of leaving that on as a placeholder. It's not gonna have a material effect on the valuation here. ENPH is something in the solar space that we've made a lot of money on in years past. We know those stocks really well. SEDG, FSLR, ENPH, they're all kind of in that group together. They're different companies, but Trader Z was hitting me on ENPH days ago and then hit me again this morning, said, keep an eye on it. Let me pass along something else that Trader Z had to say too, which is important. If we if we start to see the Russell really rock and roll here, and it looks like it's doing pretty damn good today, being up 2.6%. This is when he says, and I'll try to quote him, this is when he says, this is when the garbage starts to run.
I love it. That's my favorite.
Right? You've heard him say that before. So it's a sign that we are kicking into high gear is when the stuff that Kathy Woods buys over there at ARK, that has zero earnings and sort of like zero prospect for earnings for the next 10 years. I mean, the garbage, it starts to take off like rocket ships, right? So I don't know. We used to look at some of those like silly, charging station companies and stuff like that. And if they start to take off and run, it's like, okay, now it's game on, right? So instead of buying,
I think it was Easy Go, whatever that one is that people try to charge at the Walmart with and all that. Just I think what I news yesterday said out of all that money for the EVs, I think they've built 2 chargers so far. Out of all that money that came out of this team, not trying to get into politics this early, we still got 30.
I don't know. I don't know. All I know is Gavin Newsom misplaced $24 billion and he won't answer where it went. So, but now the hecklers are showing up at his speeches and they're like going, "Where's the 24 billion?" So, I mean, and then yesterday he comes out and starts to give us advice about how horrible the economic policies would be if we don't reelect Biden. And I'm just kind of like going, okay, so you should have seen the comments. I don't know why this guy bothers to go on Twitter, because every single comment they're like going, yeah, said the guy who's destroyed our state, and flipped us from $100 billion to $28 billion deficit, and lost $24 billion in the process. This is a guy we should take economic advice from, right?
Well, I put
there's just something wrong
on there. It says $7 billion for EV charging. 7 are currently in service. So that's only $1 billion per charger. I mean, it's pretty good.
Hey, look, Godfather, let's work on getting that contract.
I know, but the good news is all they need to do is do a 7 more and it goes down to $500 million. Right? I mean, that's when it gets to savings, Yeah. So going good.
Anyway,
there.
All right. So let's talk about the Fed and Powell.
Yeah.
So I got to put this hat on. Okay.
Uh-oh.
So I'm the Federal Reserve Chairman. I like to wear this one into banks. So when I go to the bank, I wear this hat, and you can tell, if your teller is actually like aware of like their surroundings and where they work and all that stuff. If they have no idea who this is, then you know what you're dealing with, right?
You know what you're dealing with. You probably should take your money out.
So
a bad idea.
So let's talk about what Powell might be doing. I think Powell is, first of all, the CPI data was fantastic for the markets today. Whether that, gives him the leeway to lower rates or not is not for me to really guess. I don't suspect that he's going to do it on this one print, but I do know that they want to. Now, what's interesting is, a lot of people were expecting a lot of rate decreases this year. In January, they were looking at 6 or 7 rate decreases. That got backed off to 3, and then that got backed off to maybe 0. The market hadn't run because it could have been possibly 0.
Right.
Now, most of the firms and pundits are out there saying, well, we'll get at least 1. But yesterday there was a guy on, and I like this guy a lot. I won't talk about his name and where he's at, but this guy said that his firm flat out is pounding the table that there are going to be 3 rate decreases this year.
Yeah.
It sounds a little aggressive, but I think he might be right because I think that the economy is not as hot and it's slowing really fast. And I think that if they wait too long so we could be in the beginning of a rate decrease scenario, and we could get as many as 3 but before the end of the year. And hey, if the market takes off and rockets and everybody's 401k goes to the moon, then that gives, Biden a better chance of winning. So,
right, and that's exactly right. Now, some people think, because his minutes aren't out yet, his actual speech, some people think that there's a chance that he might even announce or hint towards a September rate cut. That's some of the words on the street. I try to stay plugged into these chat rooms and everything. It makes me feel younger.
Right.
But they say that if they do, this thing will just, the top's going to blow off this market, at least in the very, very short term. I mean,
well, we've been talking about how this looked like a volcano that was building. And I mean, you look at things like FSLR, you look at things like CrowdStrike. I mean, today we're seeing the TQQQs up almost 4 or 5% again today. You're getting moves off of Bitcoins were coming back, SMLR. We're looking at the solar. We're looking at the 10 points on ARM. Okay. I mean, that's you're talking about a really big semiconductor. You're looking at, 11 points on POWL. You're looking at 6 points on Monday. We're seeing a good punch through on AMSC. I mean, the sector rotation portfolio that we have, which is the nice and easy 10-minute a week, portfolio. It takes 10 minutes a week to trade this portfolio. That thing I already looked at about an hour ago. I mean, it's rocking today.
Yeah.
And so, NVIDIA is already rocking back. It's 125 after the split. So
what about Apple? I mean, Apple. Oh my gosh! And I said it yesterday in our group. I said, you put it in the when you put it in the sector, just the notifications that the alerts. I went in on it. I was like, I know we didn't go in as a carnivore trade, but a lot of times when you put those out, we do our own due diligence, right? That's what you train us to do. And even though I'm with carnivore, I mean, you and Z are the only ones that have any control over the portfolio. They don't even want me to even pretend I know what I'm doing. So I don't, and I really don't. So, but I do love to trade what I see in there. And I saw Apple, and the thing's, what is it, 217.3 right now, up another 5%.
Well, here's the thing. When you see stuff like that come through on our systems, and Trader Z's putting it out on the systems in the morning in the pre-market, all of those system picks in the morning come off of his system.
Mm-hmm.
Okay. And so when he shows a Meta or a Apple, Qualcomm, whatever, those are coming off his systems, and it's pretty amazing how good they are. Yeah, I mean, Apple's over 20 points in 2 days. HUD, yeah, you got that right. And I'll tell you something. That's where that's where the options guys need to look. When they see, if you're an options guy and you're looking for options plays, look for the big stocks that in two places in the pre-market. One is large stocks that are hot stocks for the day, and then look for the large stocks that are in the system alerts in the pre-market. Those two spots will give you 4, 5, or 6 large companies that have great options chains that don't have wacky spreads, so that you can actually get a good options trade maybe constructed for yourself there.
That's right. And it's like you said, it's a spread and it's the liquidity to be able to get out, because there's been several stocks that we've traded with lower float that I've actually gotten the option, but there was nobody to sell it to. You know what I mean? Right. There was just that. Then that's you. But with Apple or Tesla or Nvidia, those have those are tons and tons of liquidity. You can get in and out. Even if you're wrong, you can get out fast without getting hurt.
I really like the this defense aerospace sector, ERJ. AV is just continuing to power into new highs every day. We just got LOAR, which is great. There's a small one out there that I'll tell you guys has been on my radar, but it's only 4% off of its 52-week high. It rocked up, and I'm not convinced that they do anything that radically cool. They do some, they do actually. It's a critical space solutions and space infrastructure for the government and commercial customers. So they have a lot of like fancy equipment that helps track, and have a lot of systems and camera stuff and solar array type of things for spacecrafts. But this is a symbol RDW.
RDW with Roman.
Yeah.
Okay.
This has been on the radar for a while. It's a small company with a $428 million market cap. They don't trade a lot of stock. They only trade about 275,000 shares a day. But, it's a $6.11 stock, and they did have I don't know, when was it? A couple of days ago, they were trading around, five and a quarter, 5.40, and then they just took off on Monday this week. I didn't want to jump all over it when it spiked. It peeled back, and then now it's kind of stabilizing here, and I think it's possible this thing could get ready, to make another run, but it's speculative as hell. So, but it's in the aerospace and defense area, and so that's one of the stocks. I'm looking at that sector pretty carefully because I like how the stocks trade. In general, these stocks in that sector trade pretty righteously, and the problem with the sector is there's not a lot of huge companies in there. There's a small number of big ones. And then there's, so you got the General Dynamics and the Lockheed Martins, okay? But there's some interesting stuff in here that looks like it's playing pretty good. Let me just do a quick scan here in that sector and see what I've got.
Yeah, that's right. We got 3 minutes until that data starts to come out. We'll probably see a little bit of market moving. I've got RDW. It's not showing up on our stream, but it is up on the YouTube screen. I do have RDW, which is Redwire, up on the screen right now, up 4.07 today. And of course, obviously, anything we say is not financial advice. Please discuss it with your own financial advisor. And as Trader Z says, do your own damn research. Thank you.
Yeah, and be careful what your financial advisor says, because you might be an idiot too.
Right. Make sure your financial advisor does subscribe to Carnivore. We have a special section just for them. So if you do not wish to subscribe, but you wish for your financial advisor to, just give them our link. It's below. You'll get a special treatment. We actually do love our financial advisors. We give FAs a hard time, but we've got some really good ones as CFLs. So
yeah, no kidding. So one of these that is interesting is in this. I'm going to rattle off a couple of symbols here in the aerospace sector. These are stocks that are moving up today and yesterday. It's okay. DRS. That's D like David. DRS. ATRO. TGI. AXON. RKLB. Okay, and then we all know AVAV and we all know LOAR. Those are really the top. If I had to just rattle off, 5 or 6 positions in stocks that are winning, stocks that are reasonably priced. DRS is $25, ATRO is $19, TGI is $15. Your most expensive ones there are AVAV at $219 and AXON is a $295. But and then Rocket Labs is kind of a crazy small stock, so be careful of that one. But I mean, I guess I have to say, in terms of quality, the ones I like the most would be AVAV, LOAR. Those two obviously are the ones that are in the portfolio. So that shows you how we feel about it.
Right.
All right, what do we got? We got news yet?
Yeah, well, the Fed dot plot, there's a lot of people that believe the Fed dot plot is actually the most important thing. So we're going to go ahead and get that up on the screen right now. And I'm just going to keep refresh. Yeah, the dot plot. Dot plot. I like the dot plot. It sounds like I know what I'm talking about. All right, let's see. Let's see. Here we go. So
I'm just watching. I can tell you what the data is just by how the market's acting. Geez, let's see.
2.1. Let's see. Bonds just gapped. Oh, look. Okay. Let's see. Hold on. 5.1. Let's see. Okay, so that's only anticipating potentially one cut for the rest of the year, which would be a very hawkish statement. These are coming out of the statements. I'm trying to get it up here on the screen. Let's see. What are you seeing on there? This is all real time.
Well, the Dow didn't like it at first, but now it went red. Now it looks like it's trying to climb out.
Yep.
Nas pulled back a little, but now it looks like it's stable.
We got that ready to. Yeah, we're about 30 minutes from the press conference. Let's see. The market is taking it okay. So let's see. It doesn't seem like the odds have changed that much. I'm looking at all the different screens. Let's see. The market does seem like it had a knee-jerk reaction, and it looks like it's kind of stabilized a little bit. What are you seeing on your side there?
I'm just watching. I'm watching Bitcoin.
Yep.
I'm watching.
I'm gonna pull up. I'm gonna pull up the heat map there because Dow. Well, okay, Dow looks like it's trying. I mean, it's trying to do something there.
Well, we went green. We're back in the green on the Dow, and the Nas went from 277 to 320. So it looks like they're trying to shake this thing off and say that it's pretty good news.
Yeah. Okay. There we go. I've got it pulled up, and we can see it on our screen now. That was kind of a little difficult watching it on YouTube with the slight lag. But yeah. So looks like okay. So it looks like it immediately went down. I've got it pulled up, and it immediately went down, went under the VWAP, which is the moving average for the day. But now it's right back up to 1.82 on the Nasdaq, plus 315. Dow is just going up and below the the zero line, just hovering right there. So I've got the heat sections on there. Data. EV, you said it. Look at EV charging. That 4.4 is a group. I guess that's because, like you said, the crap starts to get some bids, right? I mean, speaking of that, one of my favorite stocks, which was one of our CFL specials, was the TNA. I was playing that. Look, that's up 7% today. 38.5. On TNA, which is the small cap 3x leverage. Let's see. HUD dot plot says one cut this year. Yeah, exactly. Yeah, according to Fox Biz. I think I kind of reported that maybe a minute before Fox Business. That's okay. Let's see. S&P and Nasdaq.
You can't be buying TNA now. You have to.
Well, no, you can't buy it now. I bought it. Yeah, I bought it yesterday. I was just right for once.
Well, but you're talking to people and they're thinking, oh, maybe I should buy
Well, I mean, but look, yeah, no.
You got to tell them that when that, you got to buy it the day before it jumps 8%.
No, absolutely. Well, what would you do right now? Would you just, let's say you're not in anything. Let's say you were waiting for these. Let's say you were waiting. What would you do right now, if anything?
Well, when I see days like this, I like to be a seller.
Okay.
If I'm on margin, I'm paying off margin. I'm taking profits and I'm paying down margin, and I'm going to build up some cash. I'm not going to, sit there and push the envelope and, because today's kind of a euphoric situation. When I see Apple going up 10 points 2 days in a row or whatever, or 20 points in 2 days, I mean, that doesn't happen. That doesn't just happen every day for the next 7 days, So some of these stocks like, VRT and Powell and stuff, they got blasted pretty bad and they're knee jerking back up. I'm not going to get fooled and sucked into buying them all.
Right.
I think they're going to new highs.
Yeah.
But I do see that, stocks like
Oracle. I've got Oracle on the screen right now. It's up 13%. We've traded that one before.
I see stocks like ENPH that we bought. It's in the solar sector. It's in a sector that got its ass kicked, and it's still 30% below its high, but it's got a really nice, righteous kind of pattern to it, right? So if we're right about solar being real now, I mean, now you're kind of I prefer to go there. I sold AVAV too early, obviously, but I mean that whole defense sector, it's a safer place for me to play right now. Um, but if we're right and we do end up getting this bull kicking in, it really doesn't matter what you're buying. You can buy garbage and it's going to go up 20%.
Yeah, it was a lot. That was a lot easier. Yeah. So AVAV, I've got that pulled up. Of course, right when the minutes came out, it had a nice drop, almost down to daily moving average, and then it's kind of it's at 217.47 right now, about 2.9 up. But that's a great stock. We watched the video on one of our DMLs. I had no idea. I mean, they have a fun website with their drones, and I remember the drones. Got to have drones, and they were pretty awesome site. Let's see if we got anything happening here. When the people start coming up to the microphone, we will switch over to Powell. We are going to let that play in full, so you all can watch that. And then for those of you all that are CFL subscribers, you'll get some information there on how we may finish out the day. If you are not a Carnivore subscriber, we would love to have you come join us. Just go to carnivoretrading.com and use promo code LIVE, LIVE, and we'd be happy to have you. And you'd be right in time for our next live. We do pro trader calls every Monday, except the first day of the first week of the month, which is on Wednesdays, but that's included with your pro subscription. It was something that we used to do for the Apex members, but now we do it for everybody. And we have some good people that we trade along with. So y'all, if y'all get any questions, we have about 23 minutes. Please go ahead and
I'm gonna throw out just a couple things. If
y'all
you want
like
a couple,
the video, please help us out.
If you want a couple of stocks that we really like, that are good growth stocks that we are reasonably priced, you got AMSC at $24. It's an $884 million market cap company. Trader Z thinks this could be an easy double to 40, 50, 60 bucks a share or 80 bucks a share. He really likes it. I totally concur with him on that one. The other one that we like, ASPN, is at 31 bucks. It's up 6% today. It's acting right. It's heading towards our targets, 33. And then beyond that, I think our target on ASPN is, let me just check it. ESPN's got a 33.12 by June 16th. So that's within a couple of days. That's the target that we put down on it when we bought it on 5/29. And so we're right on track and on target there. The next target for ASPN is 47.80. And we think it can get there by around August 1st or so, 7/31. That's a hell of a jump. So we're expecting some pretty spectacular things from ASPN. Let's see here. So those are two that I would look at as really good potential growth stocks that are kind of outside of everybody's radar. And if you want aerospace, I'd go LOAR and I'd go ERJ.
ERJ, no. Yeah. Let's see. NVIDIA, we've got those. So interesting, the sectors and everything. I know that's something that we've been talking about a lot lately, and now we have the sector portfolio. And actually, the theory is trading with the sectors for a little bit lower key for those that don't have the time for maybe a high speed, low drag trading portfolio. So trading the sectors, this is something that Trader Z and Dutch, they watch the sectors and they know. And I think if you're in the right sector, this is something that I learned early on with them. If you're in the right sector, you've already got a lot of it figured out, but it's being in the right sector. In fact, if we're ever accused of anything, it's just being early. We're never late, knock on wood, never late. If anything, Z is just wizard using his crystal ball. He got one of the early ones. Mine sometimes doesn't turn on. So when you're there at the mansion with Dutch, and especially if you're up there in his office, this is what when he's doing that, he's looking for something. So you can actually say whatever you want. It's like talking to my wife sometimes. So now he's looking, so you got to be careful what you say. But when he's got his face kind of tilted up to the left, say whatever you want because he's honing in on something, and he's not hearing me, or he does it on purpose. He is. Cool hat you got on. Nice shoes. All right. Anyways, a lot of fun.
So I hit that. When we hit 1 million, I went downstairs and got on the chopper and
Right.
I did a victory lap up on the strip, and I got to tell you something. I think I blew a ring or something because there's all kinds of smoke coming out of the back of this thing. When I got about 2 blocks from the mansion, I'm like, uh-oh.
Well,
So, oh my God.
if you want something reliable, there is a nice Springfield there. You're welcome to ride it anytime if you ever get over this chopper bug.
I appreciate that. Well, we've got 2 more choppers coming in.
Yeah.
Tomorrow. We've got a Bourget and a Big Dog arriving here. By the way, Little Red, she's the Thunder Mountain. Oh my God. The paint job that she just got. That is going to be the sexiest bike in town.
I'm excited about that. Excited about that. Indeed, we've got a lot of stuff going on, y'all. We're gonna Dutch and I are working on a little bit of kind of a reality plug. In case any of you all out there have got connections into the reality show world, just if you ever watched us, especially the dynamic between the guys, it is quite interesting. It's a lot of fun to watch. So hopefully we can get that off the screen. I can just see the 4 of us just chatting in a stream. People would watch that because it's really a what show sometimes. And so let's see. We have got just over 15 minutes left until Fed Powell comes out and starts speaking. And I noticed that usually when he comes out, there's immediately some reaction and then mannerisms. And then I watch on the boards on the betting boards, and they actually try to say it depends on how many times he looks up, looks over, etc. Exactly what he's trying to convey. And it's quite interesting if y'all been watching it for a while. Let's see. Greg does bring up, he says IBIT is struggling a little. Something that he said there. Y'all, if you got any questions, post it in the chat. Let's see. Nasdaq's at 280 right now, so it is definitely below the moving average of the day, but that's kind of typical before the speech. I think people are trying to get positioned, but I think what Dutch was saying is that you already should have been positioned. So, but if you're not, I guess, make your best guess. We actually did give there was a bunch of real good stocks that was in there. If you are watching us and you don't see your little live button show live, that means you are watching the replay. So make sure that your live button is red. That's not really important right now. Well, we're just giving you amazing news. But when Jerome Powell comes out, it might be nice. Let's see. RW says CLSK was a great buy on the dip, mid 14s. Pull that one up there. CLSK, that's Clean Spark, isn't it?
Yep.
Let's see. Yep. It's 11 and a half today. Let's see here. I do need while you're looking at that, I'm going to see if I can't find the fastest feed here to get out, get the Fed meeting going. They're still waiting over here. Let's see. What are we seeing out there, Dutchman?
I'm going to sell some more IBIT here, I think.
Okay. Let's see. IBIT. Let's pull that up. Looks like what we bottom ticked somewhere around up 2.27%. That would have been 39.30. It's currently at 39.53 on my chart. 5.4, 5.5. So let's see out here. Hit over 18. Oh, is that on Russ? Is that on Clean Spark? I probably should have guessed that RW. You know, RW was Russ. There's our buddy Russ there. I had no clue. So let's see.
Yeah, he went rogue and just started trading Clean Spark on his own. So whatever. Hey man, if he can trade it good, then good for him.
Yeah,
you know,
I never had any luck with it. That's just me though. I've never had any luck with
it. It's one of the Bitcoin miners or something, and Trader Z does like that one out of all the miners, but we don't really touch the miners that much anymore.
We did Mara a couple times. But what was when we did real Hut? Remember, we crushed Hut when it was like at $1. I think.
Well, that's before we had IBIT.
That's right. That's right. And
we didn't have the ability to get exposed to Bitcoin in any real way other than through the miners. So we used them as a proxy. Now we have IBIT. So I don't care about the miners. I mean, they're an imperfect way of trading Bitcoin. So, you know what I'm saying?
Yeah. No, no. Well, that's what got me sidetracked because I did pull up Hut just to say, but it is up 17.7% today. But it's a wild trader. It's just it's a wild. That's just not fun at all. I mean, yeah, it's one of those things that. What about the guys that are in it at $68? You know, I mean, it was crazy. But like you said, IBIT makes it so the financial advisors can trade it, right? It makes it so if for those of us that do get into our margin because we don't have Russ money, then do you guys
have I know some people have been talking to me about maybe doing some leverage trades on. I mean, if there's ETFs that have sort of 2x or 3x on Bitcoin, I haven't done a lot of investigation on it because Bitcoin's kind of volatile enough, right? But, we probably should start looking at if there's maybe like a 2x Bitcoin ETF that tracks pretty good. I'd be very interested in kind of looking at that.
Yeah, so the one that I looked at BITX, Bravo India Tango X-Ray. That is a 2x on my trading platform. It is a 60% margin requirement, which is better than Hut and Mara because those are at 100%. Ones that they consider that are completely too risky. So that's good. But that's also why IBIT is nice. It's got the minimum requirements available at 25%. But that's up 5.81% today, BITX. And that's a crypto's future. And
what kind of volume do they do?
Let's see. BITX got it up right now. It is at 44,980. Turnover.
5.3 million shares average. That's not bad. 3 million already paid. All right. So BITX, good find.
Thank you, sir. 10 minutes, guys. 10 minutes. And for those of you that are watching Apple.
Now remember, when Powell talks, a lot of times the market goes up for the first 10, 15, even 30 minutes, and then it comes crashing back down. When they start asking him questions, that's when things sort of turn around. So if you're looking to take profits, you might wait until he comes out, says all kinds of cool shit, and then everybody gets excited. and they start buying like lunatics, and you can sell right into their faces and then, pick it up cheaper later.
Yeah, no, absolutely. You're 100% right. God, Apple 5.5, $218 on that thing. But anyway, so you're 100% right. And what it shows, I wanted to figure out why that was. A lot of people don't read the minutes, so when he speaks and he reads his speech, they're hearing it for the first time, which is why if you know how he's going to talk, which this is neither hawkish or dovish, unless you think that one rate cut is bad, which I guess might be. But if he indicates anything about a September rate cut, it could be interesting. I will say in real estate, the market is definitely starting to show signs of slowing down. I don't know how it is in Vegas, but even here in Tennessee, where everything has just been on fire, when I'm looking on Zillow, I'm seeing a lot more price reductions than I have seen in a long time. So, is that the interest rates? Is that recession? What is it? One of the other things that I thought of, wouldn't it be true if we kept rates this level for longer? Wouldn't we automatically start to uninvert just in the matter of time, right? Right? Wouldn't it just be time that would almost uninvert us? I mean, you would know better about that than I would, but could that also be seen as like a no landing situation?
Right.
8 minutes, and Apple going to 219. Let's see. Most everything is shaken off the recent spike down. That was from HUD. There's Nightbot. I was wondering where the hell he was. He finally decided to join our stream. Pretty bland, but SPXL for a few thousand this morning. It's pretty good. We've definitely done SPXL before, for sure. Let's see. All right, 7 minutes. Dutch, what else should we kind of hit on? What else do y'all want to know about? We've got about 7 minutes left. All right. Definitely appreciate everyone joining on. We've got a bunch of people. Please like the video if you haven't already. Definitely appreciate you on Powell Day with us, and looking forward to what he says. Hard to imagine. What do you think, Dutch? Do you think that when Trump wins, do you think that he'll keep Powell? That should get the stream going.
Yeah, probably. I think he's got more respect for Powell than he did for Janet Yellen, who was the first person that he fired when he won.
Yeah. Let's see. Yeah. Greg asks ALAR. Does anyone know anything about this? It's popping. ALAR.
Oh, no, that's ours. Yeah, that was one that Trader Z triggered, and we came in and we took it off. It's rocking. Yeah, he liked that one. That was one of his. That's got a righteous chart too.
ALAR. Let's see. Okay, leave Apple alone for a minute. Oh, ALAR. Yeah, got the.
I mean, they're an Israeli company, so that's the only negative is they're in Tel Aviv. So, but they're a software infrastructure company.
Right, and only negative just because of the situation going on there.
That's right.
Not because we have any issues with Tel Aviv. So just so you all know.
No. Just because of the Middle East situation.
Yeah, absolutely. So I've got the 1 month chart up, and it actually looks like the gosh, you talk about a lower level consolidation. This thing has spent years working all this off. Let's see. There's the weekly chart. There's the gator. So we talk a lot about it. The gator. Dutch taught me all about the gator, and it's that thing's getting ready to come up for air, right? Isn't it? That's getting ready to come up for a snack.
Well, the gator's really one of the best indicators out there. In fact, the guy who invented it was the guy who also invented the Williams %R, and he invented some other stochastic type of indicators, some that are great, including the Williams indicator. But he thinks that the alligator, those three lines that I don't know if you can see them very well, but I mean, the way he describes it is when the alligator's mouth opens, that's when the green line, opens up and and the stock's starting to climb. As long as those lines stay open, the alligator's mouth is open and he's eating. When that top line, that green line, starts to roll over and turn, kind of like you see a MACD do sometimes, then the alligator's starting to close his mouth and it's a sell signal. So it's probably one of the better indicators that's come along for our style of trading in a long, long time.
And what would be I know that you look at anywhere from an hour chart to a daily chart. I've got the weekly up. If you were wanting to trade this, what would show? Like, I've got the weekly up right now. Does that seem like a decent one for you?
All right. So let's look at it this way. If you're a mutual fund manager, hedge fund manager, or you're running a lot of money, all right, billions, then you're going to use a chart with weekly bars and you're going to put the gator on that. And that's how you're going to do your indicators, because you've got to get in and get out on a longer term time frame and a smoother time frame. Mm-hmm. If you're a normal person, you're running 20 million, 10 million, a million of your own capital, then I like to use just a daily chart, not an intraday chart. Let's be clear.
Right.
It's a daily chart.
It's a big difference.
And I look at a 1 year chart, and I want to see sort of really what the last 6 months is really what tells me is what's going on. So if I see on that daily chart, I see the gator turn and run, I want to see confirmation in the on balance volume. I want to see confirmation in the accumulation distribution line. I want to see confirmation in the RSI, and I want to see confirmation in the MACD. And so I put a lot more weight on the MACD than probably anything else. But if I see a gator and a MACD together making the move, that tells me everything I need to know almost.
Okay, yeah.
For our style of trading. Now, if you're a day trader, you got to go find what day traders use as buy and sell indicators, because they're totally different.
All right, we are getting ready. Let's see, we got about 20. We've got about 2 minutes left before this goes out. Purple says NVAX has retraced a lot. Any thoughts on entry for this one in the 1 minute we got left?
So why would NVAX be trading down on a day like today?
I don't know.
Right?
Yeah, right.
Right. So that's another lesson that I thought about before we got on the line. What's the most important thing? Price action. Why? It tells you everything, okay? You can argue with price action all you want, but price action is going to win. You can say, oh, well, you're wrong, price action. But if the price action is down and you're arguing with it and saying you should be up, price action is going to kick your ass.
Mm-hmm.
Okay? And so on a day, the NASDAQ is up 300 points. This stock is down 2.3%. Pay attention.
Yeah, no, that's a great point.
Okay? Pay attention. There's a reason for it. You don't have to even know what the reason is, but just pay attention. Because what are you going to do? You're going to dive in there because price action's wrong? Well, learn your lesson that way if you want.
Right. No,
on a day like today, the stock picks you've got should be cranking. If they're acting right, they should be ripping to the upside.
Yeah, well, I noticed that too with CRM because CRM I thought was recovering. Here he comes. I thought it was recovering. It's down 2%. Y'all, here comes Powell. We're gonna sign off. Can y'all hear that? Just
Good afternoon.
give me a thumbs up if y'all can hear that.
My colleagues
Thank
and
you
I
all.
remain
Like the video.
squarely focused
Thank
on
you all.
achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that, I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the the unwinding of the pandemic-related distortions to both supply and demand. And that is, that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. Look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Mike.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand. and we've taken some signal from that, but and of course housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It's just going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken? When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too. So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that, it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data. The labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been, has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group? of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So.
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'll be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, everyone. Thank you for watching. If you're still on the stream, appreciate it very much. Well, there you go. Go ahead and look out for the wrap. Dutch is going to have some things out there in the wrap, and there'll be some things to discuss. There was a lot there to unpack. It's probably definitely the shortest. News conference he's ever had. Sometimes they go 30, 40 minutes, and that one went for about 20 or so. Let's see, 15, 22. So either way, it was interesting. They definitely could have gone a lot longer. Appreciate it. Let's see. Greg says, what was the leverage? IBF. Yes. Let me give that for you real fast. 1 second. Let me get rid of music. All right, got the Fed music. It's worse than mine. There we go. Let me see. Let me give you that one right now. Obviously, this is not anything that Carnivore is in. Anything from them will come from them, but this is just the Bitcoin, the Bitcoin leverage that obviously for those that know me, I love the Bitcoin strategies. It is BITX. Again, that's Bravo India Tango X-ray, BITX. So, yep. Oh, good deal. Yep. Third Bay brought that up right there. Y'all, thank you very much. Appreciate you going on there. I don't know if Dutch is back on, and Dutch, if you are out there, if you wanted to come back. So 1 second. Hold on a minute. My goodness gracious. All right, I'm coming for you, Dutch. Hold on a minute. We got Dutchman down there. I had muted out our screens. Hold on. There he is. Where are you, big brother? He's yelling at me in the chat. I see you. There you are. Here, I'm even make you bigger. Look at that. We got Dutchman back here. I thought you left.
I'm like private messaging him like, I'm here, damn you.
Wait, don't go.
Hey, man.
What'd you think of that?
Look, I thought it was pretty good. He actually said he was pretty encouraging. I got to be honest with you. He really was. So what we got going is everything that we could probably ask for. from him. Now, while we were all, listening to him drone on and people ask funny questions, we went and swung the bat pretty hard on PSTG. So y'all probably saw that. Went after this is one of that was in the portfolio, and we hit it at about 67.10. We bought 10,000 shares, so that's a $670,000 buy. So this is what I'm talking about. When you get to a certain level, you can swing the bat a little bit. You can keep your stops tight if you need to. We're looking for a short-term run to 69 to 72. In tonight's wrap, you'll see the chart on PSTG, and you can see that we're in kind of a ascending channel, and also a little bit of an ascending triangle there. So I think that what we've got is a target of about 76.5, and the time frame on that is by the end of July. But we are looking for a move up to the 70 plus level within the next few days.
Wow. PSCG, we've played this one before.
Well, we're in it. All we did was add to it.
Yeah. Okay. Good deal. That's a great pick. Good sector. No, I think we gave a lot of good stuff. There was actually some really good nuggets to take away, y'all. If you just got here, if you just came in, if you're not part of the channel and you came in and watching the Fed speech, there was a couple of good things that Dutch had brought out. I may even parse out a little bit for another video, but there was some good advice, especially about the gator. There was some good advice in this video, so go back and take a look at it. And that's one of the things about carnivores; they are a wealth of knowledge. So, anything else?
All right, guys. I'm going to check out. Thanks for joining us. We'll talk to you soon.